You're not allowed to be bearish anymore. That, doesn't it feel like that?
Yeah, I think, the market was completely convinced we were going to have a recession about a year and a half ago, and kind of got bored waiting around for it. And the only thing I'm highlighting this morning is, the economy is still slowing on a year-over-year basis in nominal terms, whether you're looking at consumer spending, industrial production, retail sales that we'll get tomorrow, nominal GDP. All these year-over-year trends look the exact same. Everything is decelerating. And earnings have been decelerating for the last 4 or 5 quarters as well. But when you look at the expectations for the second half of 23 and 24, it's for a pretty significant re-acceleration. In fact, the back half of 23 has about the same similarity and seasonality to 2021 when we were reopening. And then 24 expectations at this point are 12% up from 23. So I wouldn't say it's completely undoable, but something's got to break. Either the economy has to start improving year over year, or these earnings probably have to come down.
So do you think if we just maintain the status quo, the way that we're treading water, let's call it, and we are able to do that for another 6 months, would we be able to meet those EPS projections or no?
My guess would be probably not. Maybe a little lower this year, and then next year would have to come down pretty significantly. I think to hit those numbers, at some point here, you've got to get a re-acceleration in trends economically.
I've seen people highlighting the Ford move this morning as a disinflation risk to earnings. In other words, you may have seen the news, they cut the price of the F-150. Inflation, like you were talking about nominal GDP, I mean, it does boost revenues. It does boost earnings. And then it kind of catches up with you, maybe especially on the bottom line. But going the other way on disinflation, it's great for the consumer. It's, great for the Fed, but it kind of can be a problem for corporate America, can it?
Not for every company, but for the index, when you kind of, piece together 3,000 companies, what's pretty clear from COVID is that inflation is a benefit to earnings, and probably disinflation is going to be a negative for earnings. We'll see if that's the case. It'll be a political problem if its earnings are benefiting from both inflation and disinflation.
Where would you say is the most vulnerable?
I think some of the areas that are more cyclical, traditional cyclical, so industrials, which have been very strong for the last 6 to 9 months, consumer discretionary, those are the areas that right now we haven't seen the big earnings drops yet, and if you'd have to believe a lot of those companies in those areas have been benefiting from inflation. So as inflation cools down, what I would suspect is there's probably more earnings risk than is baked into consensus numbers this time.
Let's bring the industrials chart back, because this is actually a great poster child or a microcosm maybe for what's going on in the economy, where we could say, hey, there's no way. Look at this levitation the last couple of months. This is totally unsustainable. But the flip side of that is, well, there's massive fiscal stimulus still hitting. We talked about this the other day with Robert Kaplan, formerly of the Dallas Fed. So if we have a strong impulse from the fiscal side with a lot of 2024 sunset deadlines, by the way, maybe it makes sense these stocks are doing what they are doing, and maybe those estimates are achievable.
Yeah, I think it's going to be a battle for there are legitimate secular tailwinds to industrials. It's a really broad sector, so it's not broadly across everything in industrials, but some big pieces of it. And then there's this cyclical headwind that I think is coming, and I don't know what the answer is in terms of which will outweigh the other. But I think right now in industrials, the first half of this year, the market's really just been focused on the secular tailwinds and not really thinking about the potential cyclical headwinds that could be just around the corner here as a lot of these companies kind of finish up their rebuilding their channel inventories over the next year.
So before I let you go then, when you're kind of just going through it and saying to yourself, so what gives and why is the market so strong, right? Aren't we all looking at the same numbers? Don't we all acknowledge that, to use your earlier phrase, something's got to give?
I mean, look, this could be like a 1-hour TED talk why the market's so strong. But I think look, every time the Fed hikes rates and goes through a hiking cycle, we just went through a heck of a one, right? And I agree with the prior guess that July is probably the last rate hike. Every single time the market thinks we're going to get a soft landing. Very rarely does that actually happen. But it's important to recognize that once the Fed stops hiking, all the outcomes look the same. right now, there's no way to know. A soft landing looks the same as a hard landing would look, as it looks the same as a mild recession. All we know now is the economy is decelerating everywhere. And whether this ends up being a soft landing or a mild recession or a hard landing is really just where the growth declining and the deceleration starts to stabilize. And we haven't really seen that yet. If it happens in the back half of this year, then maybe we'll get a soft landing. But historically, it would be hard. The Fed's even kind of saying they want to see some labor market weakness.